Hey, this is CatsMeow492, and I've been getting a lot of questions about this in my technical analysis post lately. So today, we're going to cover how to trade options. If you're new, you've probably been asking yourself what options are and how they're different from trading stocks. Well, options are what's called a financial derivative, or to put it another way, a financial security with a value reliant upon an underlying asset. In this case, stocks. There's two types of derivatives you'll hear a lot about, futures and options. In this video, we're only going to cover options, but I'll probably do something on futures later. Although knowing all the background behind options isn't necessary for trading them, we'll go over them briefly anyway. Options at their very fundamental level are just a contract, or an agreement between two parties to do something or exchange something at a specified date and time. So, essentially, options are just an agreement to buy or sell a stock at a defined price later. We often call this defined price a strike price. Remember that, because it will be important. When you first start trading options, you'll more than likely only be taking long positions, or in other words, you'll only be buying contracts. There are two types of options contracts: options to buy, called calls, and an option to sell, called a put. When you buy a call, you're essentially betting that the market will go up, and you'll typically buy a call with a strike price higher than the current market price. When you buy a put, you're betting the market will go down, and you'll typically buy a put with a strike price lower than the current market price. Note that options do not have to be sold at their strike price to make money. As long as the market swings your way and there's time left in your contract, you can sell at a profit. Now, there are three elements to determining an options price. The strike price. 1. If your call strike price is below the market, it will be worth more, and if your put strike is above the market, the same is true. The expiration of the contract, typically contracts that expire sooner, will be worth less. Finally, volatility. During periods of high market volatility, when the market swings up and down significantly, options tend to be more expensive. The final thing we need to cover before you're ready to trade options are the Greeks and how they affect your positions. Delta, Gamma, Theta, and Vega are all collectively known as the Greeks, and they all offer important insight in how the value of your option will change with fluctuations in price and the passage of time. If the market is like distance, delta is like the speed of a car. It's a measure of the rate the price of the option will change with each dollar change in the market price. Gamma is like the acceleration of a car and measures the marginal increase in delta for every dollar change in market price. This is why options can increase exponentially with linear changes in market price. If you've taken calculus before, the gamma is a lot like the derivative of delta, the rate of change of the rate of change. The theta is a measure of how the option's value changes over time. Options, as a rule, tend to decline in value over time. This tendency is called theta decay. Finally, Vega is a measure of how sensitive an option's value is to changes in market volatility. Options tend to be more valuable in volatile markets. You'll often hear people talk about online IV crush. That is when an option is purchased during high volatility and the market becomes less volatile, thereby reducing the value of the contract. That's it for the video. More to come soon. Get trading.